Hi, I'm Keith Richards, Value Trend Wealth Management, World Source Securities. And today we're going to be taking a look at market breadth from a little bit of a different angle. We're going to be referring to the Dow theory and one of the tenets within Dow theory. And that tenet says that the industrials, which tends to be the index that we tend to refer to whenever we say the Dow is up or down, we're usually referring to the Dow Jones Industrial Average. So the tenet of the Dow theory says that the industrials must be confirmed by the transports. So on this chart that you're looking at here, the bottom of the chart is the industrials. This is the standard Dow index that most of us look at. As you can see, the industrials made a new high last week. At the top pane, you can see a candlestick chart of the transports. And you can see that basically since February, the transports have been trending down. This, while the industrials have been trending up. So this is called a non-confirmation. You do not have the transports making new highs at the same time as the industrials. This shows us that a very important part of breadth, market participation, is missing from the current market. Let's take a look at a couple of other sub-Dow indexes just to see how other indexes have done. So I'm going to update that with the, I already did transportation, sorry. We're going to update that with utilities, which is UTIL, imagine that. So here we have again the industrials at the bottom, and we have the utilities on the top pane. Now, utilities took a real kicking from their February high, and they have been trending sideways since. Now, I should note that seasonally speaking, utilities do tend to move in their period of strength over the summer. For that reason, we have Value Trend moved into an ETF that trades this particular sector. But from a breadth perspective, as far as market participation goes, you can see that the utilities most certainly have not participated in the industrials' new high. So let's take a look at another sector. And what I'd like to look at here is the small caps. So this is the Russell 2000. Oops, there we go. So this is the Russell 2000. We're looking, I'll change this to a plain chart just to make it simple to look at. And you can see that, I'll change it to a daily. You can see that we are not making new highs on the small caps. So again, not a large breadth or a large number of participants that are moving up with the industrials. So we've got the transports, we've got the utilities, and now we're looking at the small caps, which is not a Dow index, it's Russell 2000. But we have now three indications that this market advance that we're seeing on the S&P 500 and the Dow 30 is a relatively narrow market advance. So let's take a look at one other important sector, and that is the good old NASDAQ. So I'm going to use the ETF QQQ just for simplicity's sake. And you can see it's not been bad. It's more or less flat, but it didn't quite make a new high at the same time as the industrials did. So these are a few sectors and parts of the market that are not participating in the broad movement of the Dow Industrials and the S&P 500. So I want you to understand that Dow Divergence, where we were looking at the industrials versus the transports and utilities, is not an automatic danger sign that we're looking at an absolute market crash without question, but it is a red flag. And I think this, in conjunction with some of the other market breadth indicators that I've talked about in the past, such as the new high-low indicator I talked about a couple of weeks ago on my blog, they may suggest that the market is growing a little tired and is probably due for a correction. When is the question, but I'm going to guess that that correction will be sooner rather than later. Thanks for joining me.